Hello, welcome to America First Wealth Management Investment Outlook for Monday, March 24th, 2025. My name is Dan Lew. I'm the Chief Investment Officer and Portfolio Manager at America First. Turning quickly to our disclaimer, this material is just for information purposes only. We are not recommending to offer to purchase or sell any securities, and these opinions are expressed as of March 24th and subject to change as market conditions and information changes. I'd like to begin with our market outlook highlights for last week. The U.S. stocks ended a 4-week losing streak. The S&P 500, NASDAQ Composite snapped their 4-week losing streaks, and the S&P rose 50 basis points and the NASDAQ gained 20 basis points for the week. The Dow Jones Industrial Average also edged up 10 basis points. We had some relief regarding tariff concerns. President Trump indicated flexibility regarding impending tariffs. That provided some relief to investors, although there still remain some uncertainties about trading policies that could impact market sentiment. The Fed maintained interest rates last week. They held their interest rate target steady. They did acknowledge economic uncertainties despite solid economic growth. Global markets experienced mixed results last week. European stocks had their best week in 5 weeks, but Asian markets faced declines due to geopolitical tensions and tariff worries. Our outlook for this week, we do expect more to develop on tariffs. And there are some reports over the weekend that indicated that the Trump administration may adopt a more targeted approach to tariffs that are set to be implemented on April 2nd. And that seems to ease investor concerns. And this obviously will influence market performance. And I think also what's happening is we are seeing a technical bounce. As we had noted a week or two ago, the major indices and many stocks have dipped below the 200-day moving average, and we did expect some sort of a technical bounce to occur pretty soon. And so I saw that late last week, and that seems to be continuing Monday morning as well. The next FOMC interest rate decision meeting isn't for a while. The next meeting is May 7th. We do expect that any bad economic data will be good news for stocks and bonds as this would lend support to lowering interest rates during the May meeting. Key economic events occurring this week. The major ones are occurring on Thursday and Friday. However, on Wednesday, we do have durable goods orders. Thursday morning with the GDP growth numbers. And Friday morning will be the PCE price model, personal income, and personal spending. We do expect the important data to be mainly on Friday, so we expect more market volatility Thursday and Friday. We don't have a lot of S&P 500 company earnings this week, just a handful. Tuesday pre-market will be McCormick. Wednesday pre-market Cintas, Dollar Tree, and Paychex. Thursday afternoon will be Lululemon. And also we've got Walgreens Boots Alliance. Walgreens Boots Alliance, as many of our investors are aware, is going private with a deal with Sycamore Partners. So Walgreens is likely to be exiting the S&P 500 once that deal is completed. Turning to the weekly market stats for the week ending March 21st. As you can see, all of the indices, with the exception of international stocks, ETHA, were up positive for the week, snapping the 4-week losing streak. And it was led by the Dow Jones Industrial Average, up 1.2% for the week. S&P up 51 basis points. Small caps also saw a nice rebound with Russell 2000 and 2000 growth. up 65 and 66 basis points respectively. Bonds also did well, up 47 basis points, as we saw a slight decrease in interest rates for the week. For the months to date, however, March is shaping up like a negative month, unless we get a continuation of the rally in a strong way by the end of the month. You can see most of the indices down mid-single digits month to date. And turning to year to date, most of the indices are in the red with the exception of large value international stocks leading the way up 10.65% year to date, and bonds up 1.9% year to date. Not a surprising result given the strong performance in 2024 and 2023, and also given the rapid movement by the Trump administration in turning towards use of tariffs in negotiating deals or setting policies. That's certainly creating some volatility. And we're starting to believe, as many other investors believe, that the tariff threats are more of a negotiating ploy by the Trump administration to get better deals with countries and to affect some policy change, such as providing more border security, the fight against fentanyl entering the country, and just trying to get better deals with countries regarding the tariffs that they're placing on American goods and services. So we're now starting to see a relaxation and more negotiation occurring, which we think is going to continue to drive the bounce in the markets here. Turning to the Magnificent Seven names, most of the names are still in the red last week. We did have a nice pop in the latter half of the week, which we don't see in the weekly numbers, obviously, but Thursday and Friday, strong performance in many of the Magnificent Seven names that continued an uptrend into Monday today. Apple was the top performer last week, up 2.24% of the Magnificent Seven. The only other name that was positive was Microsoft. And we did have a very strong bounce in Tesla. As you can see, Tesla is the weakest performer year to date, down 38.41. This was bounced late last week, and that seems to be continuing with Tesla up about 9-10% Monday morning. Turning to sector performance, another strong week in the energy sector, as we saw some strength in oil prices, led by increased demand and to lower supply data. Financials, healthcare, and communication services were all up over 1%. Weakest performing sectors were staples, materials, and utilities. And you can see year to date some relatively positive performance across the sectors, with the exception of consumer discretionary, of which Tesla is a big component of that, which is keeping the consumer discretionary sector down. Tech names also down year to date, but late last week and this week, on Monday, we're seeing bounces in those sectors. Turning to the S&P 500 index, we can see the dip below the 200-day moving average, which we pointed out, and the oversold indicator on the RSI below. Versus the 10-day moving average, the S&P 500 has now popped above the 10-day moving average, which had been declining. That's kind of a bullish signal there. We do expect a continuation above the line, especially if the macro data is supportive and continued Trump administration policy becomes supportive for the markets as well. Turning to the dollar, we noted last week the dollar had gotten very oversold. We've seen a slight bounce late last week and today, given the technical overselling in the dollar, we do expect a little bit of strengthening. And I'm sure the Trump administration does acknowledge a stronger dollar, probably better in the weaker one. And so by relaxing the rhetoric on tariffs, this is going to show some strength in the dollar here in the short term as well. Crude continues to strengthen off the bottom here. Did have a very strong drop since inauguration. The crude has gotten oversold, and we're going to watch that carefully. As we all know, lower oil prices has been a cornerstone of the Trump administration's strategy to lower inflation overall. So we're going to watch crude prices, and hopefully the rally in crude oil prices will not continue here, but it'll be a function of supply demand. We're going to watch it carefully. Here's a new chart that we haven't shown. Copper prices are hitting or near all-time highs. We haven't seen copper prices above $5 for a very long period of time. And that economic pundits will note copper is very good at predicting the economy, and some pundits say that nicknamed Copper Dr. Copper because it's a better indicator of economic growth or decline, better than most other single indicators. So with copper getting to these levels, a lot of activity going on there. It is getting overbought on the RSI. We do get reports that there's a lot of physical copper being transferred from the London Metals Exchange into the US, into warehouses here. And that's largely driven by the physical copper prices lagging the futures copper prices. Copper futures are up over 25% year to date, whereas the physical copper markets, we understand, are only up about 16%. That's been driving a lot of physical copper into the US. Be interesting to see if the physical copper prices continue to go up along with the copper futures prices. But we do suspect that once a lot of the physical inventory hits the warehouses here, there'll be some pressure on copper prices. The reason for that is that holding copper physically has a cost of carry, warehouse costs, insurance costs, transportation costs, and physical holders do not want to hold on to copper for an extended period of time unless they see the futures prices continue to be very strong. But at this juncture, we're looking at almost a double top here in copper. We do predict that copper prices will start to settle in and come down, especially since we're not seeing any confirmation in the construction area, which is a big consumer of copper supply. We'd really need to see lower interest rates and a huge spike up in new construction activity, which we can't confirm right now. Turning to Bitcoin, we pointed out last week that we're right at the 200-day moving average, and it seemed to be holding a good support there. The RSI was towards the oversold range, and Bitcoin is something we don't invest in directly, but we have acknowledged it as a coincident and slightly leading indicator for stocks. We do judge Bitcoin here to be bullish and supportive of stocks and also for Bitcoin itself. And as we are all quite aware, the Trump administration has been very supportive of cryptocurrency and has even appointed a crypto and AI czar to oversee the policy for what the government's going to do with regards to Bitcoin. And Trump has even stated a few times that he would like the US to have a cryptocurrency reserve established. These things obviously will take a little time to formulate policy and find the funding to support, but the rhetoric is definitely supportive. We do acknowledge it as a useful indicator, if not a strong fundamental one. it's a very good psychological one. Turning to gold, we had pointed out previously that the gold chart continued to be quite bullish. In the previous 2 weeks, we didn't feel that gold was overbought, but now we have the RSI at a slightly higher level. It does look a little overbought, so there could be some downward pressure on gold near term, especially as the dollar starts to show some strength. Usually strength in a dollar is inversely correlated with gold prices. So if we see strength in a dollar, gold prices should come in a little bit. Turning to a 10-year treasury yield, we're down 6 basis points on the week, closing at 4.25% on Friday versus 4.31% prior week. Year to date, we are down 33 basis points on the 10-year. Chart looks like we're kind of consolidating here on the 10-year, kind of going sideways a bit. And this is something we'll probably likely see continue until the May FOMC date, unless there's some key macro data driving the longer-term bonds, or if there's some negative volatility in stocks, which would drive a flight to safety in longer-term treasuries. Turning to yield curve, we do see a slight dip in the yield curve from a week-over-week basis, and also year-to-date. We do continue to note that the shorter-term treasuries are inverted at the short end, 0 months to 3 years. We're still inverted, and we'd like to see that shift to a normally sloped yield curve. The inversion does create some probability of a recession that we need to be wary of. If at some point we do revert to a normal shape curve, that should be pretty positive for stocks and the economy in general. But right now, we've got a mixed message with the inversion at the short end and the normal slope at the longer end. Turning to economic calendar for the week, we are reporting this, doing this recording Monday afternoon. We do have some data that's already been announced today. The key data point that was positive this morning was the S&P Global Services PMI flash. That was 54.3 versus the consensus of 50.8 and forecast of 51.1. So that was a very positive data point on the Global Services PMI. So that was definitely a positive data point. The manufacturing data point, unfortunately, was a little negative at 49.8 versus consensus at 51.8 and 52.1. Flip over to Wednesday, 8:30 a.m. Durable goods, month over month. Consensus is minus 0.7, forecast minus 1.3%. Previous month's indicator was 3.1%. Looking for weaker durable goods orders month over month. That's kind of being driven by the tariff volatility here. So we'll see if the forecasts are correct or durable goods orders are better or worse. To Thursday, as we mentioned before, we got the GDP growth rate, 8:30 a.m. Consensus from forecasts at 2.3% versus previous at 3.1. That would be a negative click on the GDP growth rate, which could be a concern leading into a recession, as people are quite aware, economists and most investors are aware, recession is 2 quarters of lower GDP growth. And this is something we need to watch carefully. The consensus or weakened in consensus or forecast number on Wednesday would actually be good, we think, for stocks and bonds, as this would provide a good data point for the Fed to cut rates in May. Friday, we've got the core PCE price index, personal income and personal spending. And those will be key numbers closing out the week that we're going to watch carefully. And the S&P 500 earnings, we highlighted them before, but for viewers who want to see the consensus and year ago comparisons, here they are. I'm not going to go through them in detail. We do expect these data points to be less important than the macro data points for the week. But that's pretty much it, closing out the week in terms of information. We just to reiterate, we are sitting on the bullish side of the fence this week, given the technical bounce in stocks that we're seeing, and also a relaxation of the tariff rhetoric from the Trump administration. And also, we are hopeful that there's going to be a ceasefire discussion or actual ceasefire being announced between Ukraine and Russia. That would also be a positive macro data point for the week. And that's it for our investment outlook. I'm Dan Lew. My email is shown here. Jim Monahan's email is shown here. We welcome any investors to reach out and discuss things further, or to learn more about our products and services. Please feel free to contact us. Thanks for tuning in, and we'll talk to you again next week. Take care.